Takes us to our talk of the tape, the outlook for stocks, which have a lot riding on these next several days. That's an understatement. Let's ask Cameron Dawson what's really at stake. She's the Chief Investment Officer for NewEdge Wealth. Joins me here at Post 9. Welcome back. It's good to see you.
Good to see you.
Did we solve whatever issues we needed to solve last week?
We definitely solved some of the issue with positioning. I think that is the one silver lining that came out of last week, is that if you look at that Deutsche Bank consolidated positioning report, it went from being way extended, way overweight, 96th percentile. Now it's just 31st percentile. So that just suggests that you shook out some loose hands, and that does set the stage to draw more money back into the equity market. Now, there are still overarching concerns. Do we have a growth scare? What's going on with earnings? But I think at least from the positioning front, it's good.
Yeah, what about the carry trade that got all this attention? I guess no one really knows whether it's fully unwound or what else may lie overseas based on other central bank moves. We're so fixated on the Fed here, but we're learning that other central banks hold the key very much so to where this market may go too.
Certainly. If we look at things like CFTC positioning, which is not perfect for looking at yen positioning, it has bounced back a lot, meaning that a lot of shorts have been covered. But it does raise the point that we could still be in this world of higher volatility in FX markets. And we note mostly this week, high volatility within fixed income because we get CPI, PPI, and retail sales.
What do you think is most important, the inflation reads or the retail read, given this what felt like a panic attack we had a week ago today?
Because we think that there's a greater risk for downside to growth than there is a risk for upside to inflation, we think retail sales is actually more important. Of course, if CPI or PPI comes out hot, that could spark a lot of volatility, mostly in the bond market. Remember, the bond market still has quite a few cuts priced in, 4 cuts priced in through the end of the year. But if we think about that growth story, it really will give an eye to how accurate is the labor market data. If retail sales falls off, then we might know that the labor market could be weaker than maybe some of the headline data suggests.
The way you put this to our production team was what happened last week, quote, reset the clock for equities to give them more room to run. So it got through a lot of the issues that needed to be taken care of. And now what kind of runway do you actually see existing?
Yeah, so in theory, it resets the clock, meaning because of that positioning reset, it does help to at least start from a point where we're not as stretched. I think one interesting observation, though, is we went from very overweight positioning to now neutral, slightly underweight with relatively little pain. So as people get brought back in, do we get the same kind of boost than if it had come with a bigger drawdown within the market? The other thing to note is markets got a little oversold last week, but on things like percentage of names above their 50-day moving average, we got not oversold at all, which just suggests we really didn't see a true flush.
What surprised you more, do you think? The magnitude of the Monday sell-off or the magnitude of the rebound, where we finished the week, let's just call it for the S&P at least, flat?
Yeah, I think that it is absolutely incredible that you saw it end flat, given the amount of pain that was absolutely anticipated at the beginning of Monday, and that you quickly threw away this idea of growth fears. It really helped to focus in on that maybe all of the much ado that happened on Friday and Monday was just about positioning, and maybe the growth fears were just a narrative. But that doesn't mean we can't ignore growth risk, as we hear from companies like Walmart and Home Depot this week about the consumer.
So let's go positioning then. I mean, what are we supposed to do now in terms of what the best portfolio might look like? We went from overexposed maybe to mega caps at the expense of a lot of other stuff. Then mega caps sold off in July, and we had a nice reversal for some of these unloved areas. Now we have reintroduced volatility, so I'm not sure what we're supposed to do from here.
Yeah, for us, regardless of what the overarching narrative might be, we think quality is just so very important, because what we found over the last week in our quality-focused portfolios is that because we had valuation discipline, we had really good downside capture. Just means that we go down less than what the market goes down, but you can still participate in the upside because you're not full defensive. So it's that needle to thread of saying we want companies that can block and tackle if the economy is weakening, but we don't want to be crowded in areas like utilities or staples, which we know are perking up, which does get our eye about the risk appetite in the market, but those tend to reverse gains if you do see a better growth environment.
What about growth versus value? Predisposed to one side of that trade versus the other?
We've been neutral growth versus value this year.
Why?
And that,
Why?
Because if you look at growth, what it has going for it is better earnings, but it's also very expensive and very crowded. If you look at value, it's had worse earnings revisions down, but it's under-owned and under-loved. What we've seen over the last couple of weeks is growth versus value has reversed sharply, where value has outperformed growth. It is sitting right at its 200-day moving average, so it is the most critical point to see the direction of that trend. We think it all comes down to earnings. Unless value can get its act together and have better earnings, which some of that relies on things like energy and commodities, then we think that growth can still outperform, maybe not to the magnitude, though, that it did at the first half of the year.